In this module, we're going to focus on return on invested capital and the cash cycle. When we introduced the key value driver framework, we said that there were three things that drive value: spread, sustainability, and growth. When we talked about spread, we said spread was the difference between your return on invested capital and your cost of capital. What I want to focus on a little bit more detail is the concept of return on invested capital. How do we impact this, and what are the drivers of ROIC? To understand ROIC, I'd like to start with a simple story. I was approached a few years ago by a company, and they were having some challenges with their stock price relative to one of their peers. And what their challenge was as follows. They said, look, we make the same products as our peer, we have the same profit margins, we're growing at the same rate, and we have the same risks. And the financial community agreed with every one of those statements. Yet their company stock price was not going up, and their peers was going up at a dramatically higher rate. So I asked them a very simple question. I said, what is your cycle time? And they asked me, what do you mean by cycle time? So let me give you the same answer that I gave that company. Cycle time helps us understand the business model of a company and how much cash we generate and how long it takes us to generate that cash. So in this case, business model or cash cycle of a company has 4 stages. The first stage is called raising capital. We have to have the resources to do the work, which means the investors give us cash, debt, and equity to finance our investments. We then go to stage 2 and we start making investments. We buy assets, we hire people, we do R&D, we get the product or service ready to be sold. Third, we then start invoicing our customers. We generate sales or revenue. We hopefully make a profit. We then go to the 4th stage where we then, assuming we make a profit, we start returning cash back to the investors. Interest to the debt holders, dividends, share repurchase to the shareholders. So from the time I borrow and spend the dollar to the time I collect it from a customer, how long does that take? That is what's known as the length of the cash cycle or the cash flow cycle of the business. So let me go back to the company that I was talking to you about. When we measured their cash cycle, there's a very simple formula that we can measure the cash cycle for any business or any project. We need to know 2 pieces of data. 1, how much invested capital is tied up in that business or project, and 2, what is the annual sales or revenue of the company or the project. If we take the invested capital and we divide by the annual sales or revenue, that tells us the percentage of the year that we're financing, and if we multiply that by 365, that translates that into days. So I went with the company CFO, we got out the annual reports of his company and his peer company, and then we calculated the cycle time for both of their companies using that formula. And what you see on the screen is a representation of their business model. So company A made 8 cents every 267 days. That was the company I was dealing with. And company B, his peer, was making 8 cents every 135 days. So from an investor standpoint, for $1 of investment, would you rather make 8 cents every 267 days or 8 cents every 135 days? Seems pretty obvious to me, seemed pretty obvious to him, seemed pretty obvious to the market. That's the way that the investors were viewing the business. It's not just about how much profit you make, it's about how long it takes you to earn that profit. So let's see how this would work if both companies started working on their projects at the same time. On day 135, company A isn't done. They don't generate any cash flow. On day 135, company B gets $1 of revenue. They spent 92 cents of cash along the way, and they now make 8 cents of profit. On day 267, company A now gets their $1 of revenue. They had 92 cents of cost, and now they make their 8 cents of profit. But on day 270, company B makes 16 cents because they use the same resources to sell product number 2. That's the key to cycle time, also known as velocity or productivity. And from an investor standpoint, we care about both. We care about how much you make and how long it takes you to make it. As a matter of fact, when we compare businesses, we annualize the data. If you make 8 cents every 267 days, that works out to be about 11 cents a year. If you make 8 cents every 135 days, that works out to 22 cents a year. So for the same risk and the same investment, I'd rather have 22 cents of cash per dollar invested than 11 cents anytime. That annualized data is called return on invested capital, ROIC. And what this example highlights is there are two drivers of ROIC: margin and cycle time. How much I make, how much I spend, and how long it takes me to make it. That's how we can understand the drivers of ROIC for our company and for our peers. If we want to improve the performance of our business over time, we can either improve our margin or we can improve our cycle times. We can improve the efficiency of the business, which means we can focus on things like working capital. How much inventory do we have? How much inventory do we need? And how efficient is our supply chain? What's our collection of time it takes to get paid by customers? And when we make investments in facilities, how long does it take those investments to start generating cash flow? And what is our overall utilization rate? All of these affect cycle time. I'd like to sum up. In this module, we helped you understand that margin and cycle time are key to understanding our ability to earn a return on invested capital. And how we influence each of those will help us understand how we influence the performance of the business.